All right, so hello everyone. I'm James Haft, co-founder of Crypto Oracle with my partner Luke Herner. We're a community first VC, and we're very proud to be hosting the security token track here tonight. This is the last panel of the day, and we're here to talk about the future of Wall Street's participation in blockchain and crypto, which really is an important subject if you're looking for the, for the mass adoption and the institutionalization of the asset class. Wall Street is going to play a part in it, whether you want it to or not. So first, why don't we just say hello and introduce ourselves? Which I like people do themselves. So, David, you want to start?
Yeah, sure. David Wield, my notoriety is people call me Father of the Jobs Act for so things like 506C, the repeal of the prohibition against general solicitation, got lifted out of one of our white papers, testified on Regulation A, and actually a lot of the provisions there came from back when it was before it even got wrapped into the Jobs Act. And then I was vice chairman of NASDAQ, running a new model investment bank. We do some blockchain. We have blockchain clients, probably, I don't know, about 8 or 9 engagements at this point. And so we're active in the space and continue to work down in Washington to advance capital formation to better support entrepreneurship and job growth. Love it.
Hi, my name is Monette Stevens. I run corporate development for TokenSoft. We're a white label back-end issuance infrastructure platform. So we do everything from registering the investors all the way through document review and signing, payment processing in crypto, as well as fiat, and token issuance. We're blockchain agnostic, and we're really highly scalable, secure, and compliant. We can run concurrent Reg D, Reg S sales. We can run an international sale alongside a U.S. Regulated sale. And we've been taking in investors from upwards of 170 countries. We can handle entities differently than individuals. So we're just pretty much a full service back-end platform. We've done some really interesting sales. Personally, I have degrees in computer science and electrical engineering. My graduate work was actually in queuing theory and temporal logic, which, if you guys know what that means, then you probably know how that applies. And I also co-founded and ran a broker-dealer that merged with a larger broker-dealer.
Michael?
Thank you. My name is Michael Graham. I work at Canaccord Genuity. Canaccord is a growth-oriented investment banking firm. We're publicly traded on the Toronto Stock Exchange, about $1 billion in market value. We also have a big business in the U.S. that's about the same size as our Canadian business, and we have about 2,000 institutional investor accounts that trade with our firm. Everything from the biggest, Wellington and Fidelities of the world, all the way down to small hedge funds. We also manage about $60 billion in private wealth assets in Canada and Europe. Our main business is IPOs and trading. And we are also, heavily involved in blockchain and crypto. I've been an internet and technology analyst for over 20 years and have participated in a whole bunch of internet-related IPOs over the years, and definitely our firm sees blockchain as a great opportunity.
So we're supposed to talk about the future of Wall Street and tokens, but let's start with the current, where we are today. Michael, from where you sit, you're an investment bank, you're an advisor to these transactions. Are you welcoming the transactions? Is there a platform where you can actually execute them, and is there demand?
Yeah, we break up the crypto markets into a few different segments. The first is Bitcoin specifically. The second is other utility tokens and other types of tokens that aren't Bitcoin. And then the next one is securities tokens. And we have about 5 different classes of investors, from the big institutions through family offices through our individuals that manage their wealth on their behalf. And what we're seeing right now is essentially there's decent interest in these big investors getting exposure to Bitcoin because, as a lot of us know in the room, when you add a small Bitcoin position to a diversified equity portfolio, you get higher risk-adjusted returns because Bitcoin's uncorrelated with the equities markets. Basically, the larger you go in institution size, the less interest there is. The smaller hedge funds, the family offices, like they're super interested. Over time, we see the big institutions is definitely getting more interested. When you work your way down to the other asset classes, part of the basis that I'm sort of communicating this is we regularly survey a big chunk of our clients, both the wealth management clients and the institutional clients, regarding their readiness for crypto investments. And basically, when you get to bigger investors, they don't have that appetite for Bitcoin yet. I think they will. A lot of the custody solutions and everything else that we've been talking about all day are an important part of that. And then the last thing I'll say is just on the securities tokens, there are definitely pockets of interest. I really agree. It's still fairly limited at this point, I would say. I really agree with some of the points that were made in the previous panel, which is like it's not the first deal or the third deal that is going to get a lot of interest from institutions, but it's the 10th and the 20th deals. And so we're sort of focused on trying to make sure we're in a position to impact that.
And David, could you put this into a historical perspective? When new asset classes come in and new concepts for liquidity are coming into the markets, how does the institutional part of the market react?
Well, the institutional market is very risk averse. You've got deep pockets, and you can't afford to get it wrong. If you go to Morgan Stanley, you can look it up online. They have franchise committees, and for every penny change in Morgan Stanley's equity market value, it's $17.5 million. You lose $1 because you get some kind of a whiff of scandal in the marketplace. You've just lost $175 million in value. There's no rush to get into the market unless all of a sudden you start to fear that your assets are moving out of the retail side of the business, or that institutions are pressuring you to do it. And I think as my co-panelist pointed out, people are concerned on the institutional side with custody. So I think this is pretty, if you go back through what happened during the dot-com era, for a long time that market was driven by retail investors, and it was kind of an anomaly. We had that structural shift where all of a sudden we had direct investment through the E-Trades of the world, and there was massive growth in E-Trade accounts, just like we've seen in terms of cyber wallets, mostly with retail. And it wasn't until the institutional investors started to lag the performance in the overall market that they felt compelled to get into the market, and that took the market up second leg. But here, we're issuing completely new securities. You're not participating in the broader, stock market. So I don't feel like there's any of that pressure. And until we suss out the risks, I don't think the institutions are going to come in a big way. I agree with you. You can look at it. Bitcoin is sort of an asset class in its own right as a cyber currency, but sort of everything else right now is too small and not interesting enough for the major institutions to take a risk.
And the exchanges, how do they look at these assets?
Well, I think that there's a lot of volume, and I think exchanges are interested in moving in that direction. But there are so many new entrants coming into this market right now to trade that I think you monitor and you acquire is what I would do. I was, as I said, I was vice chairman of NASDAQ. You have to have something material to move that earnings per share needle, and so you can play around. They have a venture fund. It's actually run by a fellow who is a former head of the strategic investment group at Morgan Stanley now. But I don't think that until there's really sort of volume and the kinks are worked out, that there's any reason to get into the market. And I would, if I was a CEO, and I know Adina Friedman, who was the CEO of NASDAQ, I'd probably acquire my way in.
And Monette, you're working with the investment banks to try and help them accept the asset, right?
Well, we're working with institutions in a number of ways. A lot of the institutions I've been talking to and some of the largest financial institutions in the U.S. as well as globally are looking at tokenization as a way, and at blockchain as a way to be able to decrease costs and increase their efficiency for different financial products that they're developing. So they're looking at the different blockchains that are focused on the financial sector and doing different pilots, or I don't even want to call them pilots, they're doing initial issuances. So if you look at what World Bank and Commonwealth Bank of Australia are doing, they're doing, I can't remember the number, 100 million-ish, I think, bond issuance on, I can't remember which blockchain they're doing it on. And, we're involved with a lot of these different projects at different levels. The other thing that we've been seeing a lot of are asset managers who are looking at tokenizing different funds and then being able to offer that either equity or debt-backed issuances. And then as part of what we're doing post-issuance, we work really closely both with the crypto exchanges as well as looking at what the standard exchanges like the New York Stock Exchange, NASDAQ, the London Stock Exchange, Swiss, SIX, as well as Malta, Gibraltar. I mean, a lot of the stock exchanges, I'll keep going, I don't want to leave anybody out. Singapore are looking at incorporating, crypto as well as, different issuances in their, trading platforms. So with one of the things we've done recently is put forth the ERC 1404 standard, which supports secondary market compliant secondary market trading. So when we're working with issuers, we are trying to help them strategize that so that they're going to be able to trade their tokens on the secondary market.
Is that private markets, public markets, or both?
Both, yeah. So
simultaneously?
Well, it depends on how it's being issued. I mean, so we are, the way that TokenSoft, what we've done is we got involved with ICOs and realized that there was really no platform that was supporting global issuances in a really compliant way that was enforcing different compliance in different jurisdictions uniquely. And so that's what we built. And then we take our direction from the SEC, from the legal counsel for the issuers to determine, how it needs to be enforced. And so we follow on it. We do that. That's what we do. Does that make sense?
Yeah, I think so.
I mean, most if you're doing an issuance in the United States, most of these things are going to be done as typically 506c private placements initially, with a Reg S bucket to distribute outside to foreign jurisdictions where there tends to be a little bit more openness, at least in the European market. So I would, are you kind of keeping track of the back end in that instance, so that those Reg S shares are not coming back into the U.S.?
Yeah, so, as well as holding periods for, Reg S versus Reg D. The other thing is what we've done, or what we've seen, is some of the issuers are actually doing an international issuance, not a Reg S, so outside of the U.S., and then they're running a U.S. offering under, Reg D. So, yeah, and then we keep track of that, so that the secondary markets, you're not trading tokens that were issued under, either an international sale or a Reg S sale, with U.S. investors.
So you end up with two pools for a period of time before you convert.
Correct.
Michael, how do you see the path forward? Which securities, offering types, what kind of products are going to start to come first, and as the dam starts to erode before it breaks, how do you see that happening?
Yeah, I think that it's most likely, from our perspective, that Bitcoin sort of trains the institutional investor to own tokens. gets them, set up with custody solutions, gets them set up with working with their LPs to get permission to own tokens. I mean, there's a lot that goes into, taking an equity fund and getting the permission and the capability to add a 5%, position in Bitcoin or whatever, right? So I think Bitcoin's going to train these organizations. I think it's going to take some time. Probably we could be here next year, and if the percentage of sort of traditional equity asset managers that owns Bitcoin right now is way less than 1, I would imagine it's going to be way less than 10% by next year. I have no idea, but and then I think what I'm hoping to see is that you're going to see a whole bunch of security tokens come out that sort of fit the bill of some of the things that people up on the stage have been talking about. It's a new investment idea. It's high quality. Maybe it brings liquidity to an asset class where liquidity hasn't really been there before. Like real estate is a great example. Maybe the tokens have particular governance capabilities, or maybe they have really good shareholder-friendly, distribution mechanisms, like whatever it is, things that make those securities attractive relative to other types of securities. And then I think after that, and much longer term, we're likely to see a wave of more science-y, blockchain-y, utility-type tokens in the market that are solving problems. It looks like a SaaS, like a software upgrade cycle for enterprises and everybody else, and that's going to take a long time. So that's kind of the way we see it evolving.
David, do you see the major houses starting to look at these types of offerings as security tokens look more and more like shares? Do you think this becomes a product that complements or replaces share offerings?
Not yet. They need to be larger, they need to be scale, and they need to work, and they need to be largely de-risked, and I don't think we're there yet. I think that, you kind of have to ask the question, what is tokenization doing for you? I kind of totally disagree with the last panel in the sense of, creating liquidity, and when you're looking at micro little, issuances, they're not going to be innately liquid, because you have the same problem you do with microcap securities when, an academic will say, you got, they call them asymmetrical order book markets, big seller, no buyer. And you really need an intermediary in the middle providing research and sales support to make those tokens or those securities liquid. And so, but where I think it does become really interesting is, when you're looking at the protocol and the application layer, the things where you actually get rid of a lot of the legal paperwork, particularly in private markets, you can facilitate, you can get rid of all the legal kind of constipation and automate a lot of that away. I think that's really interesting. But the issuers, if Barry Silbert, who was founder of Digital Currency Fund, and I was advising Barry back when he was doing second markets, and what they learned there was that they were making markets in unicorns, effectively, like Facebook before Facebook was public. And they found that issuers really didn't want to lose control of their trading, because what happens with microcap or illiquid markets, opaque markets, is they tend to trade to a discount. And of course, that's anathema to doing the next round. In the case of a unicorn, you want to manage the rounds, the A, B, C, D prices. And so where you started to go was into a structure where there were tenders that were controlled by the CFO, and they controlled where those were going off at, and they'd work with an institution who wanted to back up the truck and own the security. I think that where this technology becomes really interesting is I think that a lot of the paperwork kind of starts to go away and gets automated in the application layer, and I think that's actually very interesting for the private market over the long run, but it's going to take a while for that to get adopted, and it's not till the companies get really large that I think you're going to start to see institutional investors cross over into those private markets.
I just reinforce that, like, liquidity is huge. I mean, when you're talking to a portfolio manager about a thinly traded, stock, they don't really want to entertain it, especially if it's, a book of any decent size. So it's going to take liquidity building slowly, over time for this to work.
And so your father, the Jobs Act, and so crowdfunding, which is the whole idea of collaboration and peer-to-peer, decentralization, the idea of going to the wisdom of the crowd for investments is part of the core belief of crypto and blockchain world. How do you see that interplaying into what's happening right now? And do you think the Jobs Act and 8+ and all the other ways that have come through Washington are helpful and going to be useful in this process, or do you think they're just going to be, I don't want to put an over conclusion?
I mean, but there was in the Jobs Act 3.0 that just went through the House in a vote of 410 to 4. It's 32 elements in that particular bill. It hasn't made it to the Senate. One of the more interesting ones is the venture exchange legislation that essentially rolls back a lot of the requirements of today's public markets that gutted the sales incentives and the trading incentives for market makers, okay? And market makers are essential in whether it's tokens or it's stocks until you get to a certain size, and because of so-called network effects where you've got thousands and thousands of investors looking at a token or a security simultaneously, that there's innate liquidity. Intel is innately liquid. Just get out of the way and let the orders interact. ExxonMobil, innately liquid. But when you get into these, micro-cap issuances, they're not innately liquid, and there has to be a mechanism to drive that liquidity. I mean, there are folks out there working on, for instance, artificial intelligence solutions to provide information on real estate properties. Why? Because you want to be able to look at the value. It's got a yield associated with it. But that stuff's not going to trade with any kind of velocity, but people may, chip away at it on the shelf, and maybe that may emerge because people will look at the yield. But if you're looking at a stock, or a company, an operating company token, and it's small, it should be in the private placement market, it's not going to trade very well. I mean, continuous offering markets are really sort of anathema to that kind of a security. But in the long run, we just have to keep chipping away from a public policy standpoint to create toolkits that get more of that $30 trillion in equity assets that are in the institutional market, and to bring it down into the microcap markets to get the small IPOs to come back again. They used to represent 80%, defined as sub $50 million in size, probably 85 million in if you go all the way back to the 90s and control for inflation. They represented 80% of all IPOs. It's down below 20%, right? So to get that, to bring those back, that would be the real opportunity, and that will then spread wealth and capital into all private placements, whether they're tokens or securities. That's the big sort of secular change that needs to occur.
Mike, I wanted to come back to you because do you believe that we can get back to democratized markets?
Yeah, just a super quick, build on that. Like one of the major things that's pushed the IPO market, further out in the company formation is the rise of private equity. I mean, we always talk about the major force in the equities markets being the shift to passive investing, and how that's causing a lot of correlation of returns and less volatility in the markets. But the other big thing has been that private equity funds under management have grown massively over the last 10, 15 years. And one of the things that's interesting is, can the STO market bring some private equity oriented money into new types of products that are sort of outside of the traditional VC industry, and as David said, like maybe create a little more of a smaller offering thing, which we would love to see.
That would also entail a change in the marketing strategy of Canaccord and the other big banks, right? Because right now you're marketing to institutions, not really individuals.
Well, we do have a big wealth management business. We obviously have a bigger business with institutions. I think at the core we're trying to help worthy issuers access capital, and and also provide good returns for our investor clients as well. I think that you can the smaller and less liquid the investments are, the more likely you're going to have inefficiencies in the market that our investor clients can exploit and make outsized returns. So I think a paradigm like this, where we sort of get away from big private equity, probably helps the smart investor, do a little better.
And Monette, in the offerings that you guys are handling, are you seeing, what's the balance you're seeing? What's the demographics of the investor base?
Well, we're seeing a lot of larger private investors and institutions, family offices, and then it depends on the type of the sale. We've done some broader sales where there have been, a larger number of investors, but internationally. We did one sale that was based out of Australia where we brought in around 28,000 investors. That was a pretty diverse investor pool. What we're seeing with a lot of our larger sales, particularly the private sales, and so we'll often work with a company when they're doing their initial pre-sales, which is usually targeted to a small number of investors, and usually those are larger investors, venture capitalists, VCs, whatever. And then they'll do a broader private sale, but it's also to a set of accredited investors if it's domestic, and again we're seeing larger investor entities and pools that are investing in that. So it just really depends on the type of the sale, what we see, and we've done some issuances that have been very broad. And I'm not really sure what I can talk about, so I'm being a little bit cagey.
Name
I
companies.
apologize.
So, David, how much of the holdup right now is the regulatory opacity, and how much of it is a lack of demand?
I don't think there is any regulatory opacity. I mean, 3 months before Jay Clayton came out and said he hadn't seen, this is the SEC chair, and said he hadn't seen an ICO yet that he didn't think was a securities offering, we told everybody in our investment bank that we were going to treat them all as securities offerings. I mean, so you've got Reg D, you've got a couple of flavors that are relevant. It's 506B, which is where the accredited investors you're going to, and you do an institutional or typically quid placement, but also you go to accredited investors if you have individuals, if you have those relationships, where you do a generally solicited private placement, and it has a different, a more burdensome mechanism because you need a third party to verify their accredited investor status. Then Reg A, you can use, actually most of the Reg A offerings that are getting done right now, they're restricting under the shareholder rights agreements the trading, and so I think about 80% of them are non-traded, but they're publicly reporting. A lot of it's being applied to real estate, and then but one of the problems if you try and list in the United States on a major exchange, you have to worry about 12G because it still requires once you're trading, you're still required to have a transfer agent, which the block arguably substitutes for, and so I think the SEC is being in that particular area very deliberate about because they want to make sure that they don't make a mistake and waive something, and so everything is vetted. This is I remember speaking at a panel a while back. It was in February, and somebody asked me, what did I think of all these exchanges that were trading these cyber currencies? And I said most of them are illegal. And there is a well-oiled regulatory and review mechanism for securities. There's laws and the tokens that people are issuing, or if it's a currency, the CFTC. The rules are there, the principles are there. Follow the rules, follow the principles, at least in the United States. Otherwise, it's going to end badly for you.
Michael, again, the balance between the friction, is it regulatory side or demand side?
I agree with the comment that I don't think there's regulatory opacity. I think, there was when people were trying to not follow the securities laws. To me, it's about demand, and, demand is going to develop when investors can earn superior risk-adjusted returns from investing in this asset class relative to other asset classes. And so, the 2 or 3 key words are risk-adjusted and returns, right? And, returns is driven from we need to have good ideas, good projects, good companies that are growing, taking market share from traditional companies or industries, or doing things in a fundamentally better way that, is attracting customers and just growing, right? And then risk adjusted, we got to have liquidity. And so until, as those things build over time, you're a Wall Street veteran too, James. I mean, you've seen this, like, a lot of times it's a killer app that can come out and develop and sort of cause a tsunami to start to happen. In the case of digital advertising, like Yahoo did really well for a while, but it didn't really change the game until Google came around and applied, automatic algorithm, learning, and, the search algorithm just sort of fed on itself. And that's, it was only 10 years ago that, Yahoo had more search share than Google, right? And then all of a sudden, they just opened the floodgates, and that's really when the digital ad markets took off, and now Google and Facebook are, half of the global ad market. So it could be that we just need one great idea, one great project to come in and just fuel the whole thing.
Killer app, I agree with that. But, so these guys won't take the bait. I'm trying to now go to Monat. Regulatory or demand? In terms of what's holding up being, bigger offerings, more liquidity, things moving forward.
Well, I mean, I'm not a regulator.
No, I'm saying from your experience in dealing with offerings, you're the only one up here actually doing offerings right now.
Yeah, I mean, we're seeing, the thing I think that's holding it up at this point really is people's, or companies' hesitance about what's going on from a regulatory perspective in the market. And we're seeing a lot of issuances, we're seeing a lot of interest internationally. We don't do a lot of work in Asia, although we do some work in Asia. We're seeing a lot of interest in Europe, particularly, Switzerland and in that area. And actually Australia, we're seeing a lot of interest there as well. But what we've seen with kind of a little bit of a bear market in crypto is that people are waiting longer and wanting to do a little bit smaller initial issuances. And the one thing that's really changed for us over the last year, and we've worked on around 20 issuances over the past year, is that people are waiting a little bit longer to go out to market, and they're also taking traditional investment initially. So they're raising capital as equity first and then doing an issuance. And, but that's different than the funds and asset managers that are just looking at tokenizing and offering a tokenized financial instrument. So
it's performance, right? I mean, the cryptos, had a little bit of a collapse there. It's settled out. ICOs, or the vast majority of them, are underwater. If investors make money, there'll be demand. Demand will grow. If investors don't make money, they won't. But there was an enormous tsunami of complete crap that came into the market. If you read through a lot of these white papers, there were no risk factors sections. You really didn't know what you were buying half the time. What was the economic bargain? I mean, so from a disclosure standpoint, the industry, and it's been written about, in the Wall Street Journal and elsewhere, was rife with fraud, at least from the standpoint of material, the legal standard of material omissions. The fact that it went to the public. So, so we're going to have to kind of digest the crap, and my colleague here was making the very, very good point. It's the quality of what people are selling, the quality of the business models, the quality, the stage of development. Most of what you saw in the kind of the early wave, people didn't even have a mock-up, a demo of what they were providing. I mean, this stuff was complete startup fare that never should have been sold to the public to begin with, but people threw caution to the wind and somehow deluded themselves into thinking that the securities laws did not apply, and guess what? They do apply.
Yeah, we've been very careful from day one and Mason was on a panel, our CEO, earlier, where he said that he spends a lot of time, trying to dissuade people. And so we've been very careful from day one, really only taking clients that are, doing something substantial. And a lot of our business comes in through the securities attorneys. And so when someone really comes into where we're going to actually work with them. Usually they are relatively substantial in terms of what they're doing. Again, we work on larger issuances. We have a minimum threshold under which we're not really going for a number of different reasons.
What's that minimum?
Okay, I'm not going to disclose that right now. But we're pretty careful. But what that's done is we've seen and we've run and we've handled all of our issuances since our inception as security offerings. And so we have followed, protocol in terms of taking investors through KYC, AML, OFAC checks, U.S. investors through investor verification. If we're doing an issuance out of Switzerland, let's say, there might be an additional requirement for the KYC where they have to do, a time-stamped, photo that is then compared against their documents that they upload. So, our focus has been to run, compliant, regulated issuances and enforcing the regulatory environment for wherever either the investor or the issuer is coming out of. So, we're trying to stay close with what's going on in the, in the regulatory community. And in a way we see that's just the way we think it's going to go.
All right. One word answer.
Sorry.
Last question. It's okay. Bull or bear on security token market over the next 3 to 5 years? Bull or bear? Bull. Monette?
Bull.
Okay. You had to say that. David?
Slow bull.
Okay. All right, guys. Thank you. Thank you all.
Thank you, James.